and welcome to this discussion on international trends in crypto investing. I've got a stellar panel lined up for you today to discuss all the key trends and movements in this fascinating market. As always with these sessions, these weekly sessions, we've got PCD members with us on the Zoom call. We've also got a broader audience with us on YouTube. Both are able to submit questions that I'll bring live to the panel as we move through. We're going to chat today for about 50 minutes, and in the last 10 minutes we'll say goodbye to our YouTube audience, cut the stream, and we will do finish off with a live Q&A and a little bit of networking with our audience here on Zoom. So without further ado, I'd like to get straight into the discussion. And I'd like to welcome Anatoly Crachilov from Nickel Digital Asset Management. Good afternoon, Anatoly.
Very good afternoon to you. Very nice to be here.
So to open up this discussion, you started your career in traditional finance. You've now been heavily immersed in the cryptocurrency space for a number of years. How have you seen the market develop in that time?
Well, indeed, I have been in investment banking for a number of years, for 25 years, and for 7 years before Nickel Digital with JP Morgan and Goldman's. And actually, the whole conversation around crypto emerged in a serious level around 2017, when many Goldman clients were coming back to the firm with the question, are we missing something? Do we have to be exposed to this asset class? And of course, many were not exposed at the time. And actually, we took a very constructive view, saying it can evolve in the new asset class. It will remain volatile for the foreseeable future because as any new technology, it going through the early stage of adoption curve, the price action will be anything but a straight line. Price discovery will be a painful process. If you as a client can take a constructive view on underlying technology and allocate with the long-term horizon, there is significant appreciation potential. If you can trade volatility, that's a beautiful asset class to be in, given the underlying vol. And to me, that was a complete career change as I started to immerse myself in the underlying technology. It led to me leaving traditional banking system and building Nickel Digital, which is a dedicated investment manager offering access to crypto market for incoming institutional investors. 2 years ago, it wasn't obvious whether they will show up on your doorstep, but now it became kind of on everyone's radars, right? So over these 2 years, we've built platform to allow various access points. And here to the what sort of access people are looking for. You can either go directional with crypto, which bears its own volatility, right? Or you can trade volatility in a different manner by not taking directionality bets, but rather exploiting inefficiencies, price swings, volatility in this asset class. And that's exactly what we decided to deliver as our flagship offering. And for many of our investors, that's a kind of easy transition or kind of first step into crypto before they become comfortable and then look on other implementations as well. And today, of course, there is this whole range of investment solution, starting with arbitrage, which is by its nature super conservative. We've been in trading for 2 years. It happened to be 2 years of all positive returns with no drawdown months. With rolling performance of 20% and very high Sharpe of 4.8, that's a reflection of conservative. But there's a more and more demand for more directional exposure. And that's what we now launched, Directional Bitcoin Fund, as well as DeFi Fund. And decentralized finance, to me, this is kind of an inevitable, highly competitive environment for capital efficiency. And decentralized finance will certainly kind of eat into traditional banking system for the simple reason it's an algorithmic form of financial services. And we've seen this before. Look on the Wall Street trading desks. There used to be tens of people trading European equities. By the time I left Goldman, there were 2 people trading the same desk, right? Because everything went into algorithmic form. So we're going to see the same stuff with traditional banking system, which so far has been perhaps the most conservative part of all other industries. We saw retail reshaping completely because of Amazon. Many other industries went through this tremendous change, but not really financial services. So DeFi is likely to be the one which is going to move this. And even today, you look on DeFi, there is subsection of borrowing and lending. Well, that's exactly what commercial banks do. They borrow on one side, they lend on another. And in the middle, you have bricks and crowds of people managing this flow. As a matter of fact, you can replicate the same function on a blockchain, right, with a far greater efficiency. And that's what gave rise to this DeFi space. A year ago, the total capital locked, which is an interesting indication how active are investors in the space, there was $1 billion. By the end of 2020, it grew to $15 billion. And now we're standing at $60 billion. That's kind of an indication how aggressively this space is expanding. And that's where the opportunity lies.
Thank you. We're going to pick up on DeFi with Aaron from Gibraltar later in the conversation. But I mean, how were your strategies affected by recent volatility? There was a lot in the newspapers because retail investors who put small savings in, would really feel the pain of those. But by the sound of things, your strategies weather that kind of price volatility because it's anticipated to some degree. How did you find it?
Absolutely. So the strategy is designed to actually take advantage of these volatility swings. And May essentially was one of the worst months for Bitcoin over the last nearly 2 years. So from April highs to May lows, it was over 50% drawdown. May was minus 36 from beginning of the end. We made money in this month. So we were up 2.6%. And that's exactly what the strategy is designed to deliver, right? It is not designed to compete with Bitcoin if Bitcoin delivers 300% as it did last year, but it will deliver in any market environment, including when Bitcoin is down 50%. And that's kind of the way we approach this volatility, because underlying market has vol of 75, and we're converting this into the fund level volatility of 3.5. 3.5 is lower than US treasuries. Honestly. So that's how you can approach, you can manage this volatility. It requires, of course, complex strategies and trading systems and risk management, which is 24/7, matching the underlying crypto market, but it's doable, right? And for those clients who are in capital preservation mode, that's exactly the strategy they're looking for. The kind of free from these massive swings, visibility on the returns you are getting. And for many family offices who are generally in the capital preservation mode, that's what clicks with them the most. So answering your question, you can navigate well from these volatility times.
And just looking at the family office market, I mean, are you seeing that the conversation has changed as the market has matured from, people are know that they need an allocation to crypto, and then they might come to you to work on it. It's a given that it should be part of the mix. Has the tone of that conversation changed with family office investors? Are there still skeptics out there who are long real estate and other assets? Or do you still have to have those convincing conversations, or far fewer?
I would say majority are still skeptic, right? Kind of, this is very natural evolution of thought. But I think what we've seen over the last 18 months, and COVID surprisingly was a trigger for this deeper review of this asset class, because all central banks engaged in the policy of kind of helicopter money, right, essentially kind of saving the economy. If you look on the US M2 money supply, it went up 28% in a single year. Well, which means from all the dollars in circulation, over 20% were created over the last 12 months. And that naturally drives this, like, okay, how do we protect our capital against what is seen as capital as currency debasement? And of course, it's currency debasement. So crypto suddenly became an interesting asset class to put in your, to kind of include in your portfolio for the simple reason. There is a scarcity inbuilt in the, say, Bitcoin. Let's talk about Bitcoin, right? Given that there is a cap of 21 million, of which 89% already in circulation, and the remaining 11% will be issued over the next 120 years. That's by design of the underlying protocol. But more importantly, you have absolute visibility, how many coins will be in circulation, say in March 2035. Can anyone tell me how many dollars going to be in circulation in March 2035? Of course, no, because there is a single entity which defines that, called Federal Reserve System. The only thing we can assume kind of safely, there are going to be much more dollars in circulation. How many? Who knows? In crypto, you have this full visibility and immutability, which is very important, right? And that's what drives scarcity element. And suddenly it's seen as inflation hedge. And it's perfectly kind of, that's the value proposition of Bitcoin in particular. Now, the question is like, hey, it's very volatile asset class. How can you include it in your portfolio without damaging the risk profile? And the answer to that is sizing. If you size it rightly, say, well, let's start with a conservative 1%. 1%, however volatile is 1% in your larger book, it will not affect negatively your overall portfolio, right? If you do 3% statistically, and we have built statistics over the last 8 years, it's, as a matter of fact, has a positive impact on your standard deviation, which is counterintuitive. You add a very volatile asset, and yet it improves risk return profile. And the answer to that is yes, because it's uncorrelated to other asset classes. You can run statistical review of all drawdowns, major drawdowns of S&P 500 over the last 10 years. That's what we've done. And then you superimpose Bitcoin moves over the same period. And surprisingly, Bitcoin has very high degree of independency from S&P 500. And that's exactly the diversification which you want to own in your portfolio. That's why when you add in a small quantities, 1 to 3%, it has incredible positive impact on your overall portfolio. The efficient frontier shifts up, your overall return goes up, but fundamentally your risk remains under control. And that's how many investors started to look at crypto from portfolio construction point of view, and it's very healthy. That's what adds value on the overall portfolio.
Perfect. Well, thank you for getting this conversation underway in such an interesting fashion. Anatoly is a true investment expert on this space. Don't miss the chance to ask him a question. Put your questions in the chat and I'll bring him back on. But I'm going to come on now to Syed Rahman from Rahman Ravelli, who is a UK lawyer specialised in this area, particularly around fraud and asset tracing on crypto. Syed, good afternoon. Welcome.
Good afternoon.
So perhaps we talked there on some of the investment side and managing that investment risk on the legal aspect. Perhaps you could take us through a typical investigation process, looking at people who've suffered losses around crypto and share some of your experience.
Sure. Well, good afternoon, everyone. And as David explained, my name is Syed. I'm a lawyer at Rahman Ravelli, and I focus on white-collar crime, cryptocurrency-related fraud, asset tracing and recovery. Everyone in the audience, from an investment and commercial perspective, legal and regulatory position, however, is still a developing area. The law is yet to catch up with the rapid emergence of crypto. One of the appeals to cryptocurrency is the anonymity that many believe it offers. And I'm sure we've seen examples in the media where wrongdoers use crypto as a means to engage in fraud or money laundering, etc. This is a very dense topic, and while there's a lot to cover in a short period of time, I'll try my best to spend 4 or 5 minutes and explain how, with the right tools and the correct legal applications, crypto assets can in fact be identified, traced, and safely recovered from wrongdoers. We need to dispel the myth that cryptocurrencies are anonymous. While it does give users a degree of privacy, they can actually be identified. So let's say, for example, David were to hack into my bank account and steal all my money. Sorry, David. And he then thought the best way to hide this money is to open 10 different bank accounts and spread the money across each of those accounts. So spread the funds from bank account to bank account, and then eventually look to cash out at the end. Now, as a lawyer, when I'm conducting my tracing exercise, it's somewhat difficult for me. I would have to make legal applications to 10 different bank accounts so that I can follow the money. But if David stole a bunch of Bitcoin and then opened 10 addresses and decided to move the Bitcoin around before he cashes out at an exchange, I can see those in seconds within the blockchain. And I can see all of the transactions by following the flow of transfers between the wallets. So you can already imagine crypto-related investigations are very different to the traditional asset recovery investigations that we deal with. So if you've been defrauded or hacked, there are really 3 or 4 factors to ensure success of recovery. Summarize each of them. Number 1 is pre-seizure planning. Now, there is nothing that ensures success when recovering assets more than pre-seizure planning. And what I mean by this is a strategy to evaluate the material and any evidence with the view to applying for freezing injunctions and freeze the crypto assets. We all know crypto assets are truly global. And in my experience, we've seen bad actors use cryptocurrencies in various jurisdictions. And this has to be taken into account in the pre-seizure planning phase. You'll appreciate, not all countries have the framework to deal with crypto assets or freezing crypto assets. So you have to think about alternative solutions beforehand. Number 2 is the intelligence collection. Also the investigation, the right software and algorithms for tracing the crypto assets must be used. And this is so you can have an accurate blockchain analysis. Such analysis will prove essential when you make the legal applications, which brings me on to number 3. Now, number 3 is what I usually refer to as before takedown. And this relates to the significant legal tools that are available in England, which include worldwide freezing orders, third-party disclosure orders, and other types of urgent injunctive relief, depending on the merits of the case. Finally, we have number 4, which relates to the actual takedown. And this is the seizure itself. Successfully frozen the assets, you can make a claim and eventually obtain a judgment to have those crypto assets returned back to you. So that, in a nutshell, is what a typical investigation would look like.
Okay, thanks. We're having a couple of problems with your mic side, but let us carry on. I mean, if you could cover the leading cases from the courts freezing crypto assets. I think there's some cases that you've worked on personally that I think would be very interesting to share.
Yeah, sure. Well, look, in terms of leading cases, fortunately, cases are actually our cases. First is AA versus Persons Unknown, where we acted for an international private client. And this is a landmark judgment, as it was the first case in the UK where Bitcoin was defined as property. And as a result, a proprietary injunction was granted over the crypto assets. And this case relates to a Canadian insurance company who fell victim to a hack, and the hackers threatened to encrypt all of their files and demanded a ransom payment in the form of Bitcoin. I think it was somewhere around 20 servers, over 1,000 computers that were encrypted. Now, once the ransom was paid, legal applications were made to trace the Bitcoin, freeze it, eventually bringing the wrongdoers to book. So that's the first case. The second case relates to the case of Ion Science Limited versus Persons Unknown. And here we were able to successfully obtain a worldwide freezing order in relation to Bitcoin that had been dissipated due to cyber fraud. And we were also successful in obtaining disclosure orders against the exchanges that held the Bitcoin. Now, I can't say too much about this case because it's still ongoing. However, I can tell you what's in the public domain. And what's important about this case is it's believed to be the first case or the first ICO fraud case to be brought before the commercial court. It's the first time a court considered the lex situs, or the location of Bitcoin, which of course helps us with the arguments relating to jurisdiction. And finally, we were able to serve relevant orders outside of the jurisdiction by alternative means, such as email. So there are many other cases that we've been involved in, but those, I would say, are the leading cases in the courts at the moment.
Okay, well, thank you, Syed. Your mic's still a little bit in and out, so we're just going to move on to Martin. But if anyone in the audience has got questions for Syed, or for Anatoly on investment or on the fraud and legal side, do put them in the chat and we'll bring them back on. So welcome Martin Burgherr from Sygnum in Zurich. Good afternoon.
Good afternoon.
So we heard from Sid there some of the risks that people can face, in terms of hackers or fraud. Could you just explain how working with a custodian such as Sygnum can help private clients protect themselves in this regard?
Yes, I think that's a very valid question. Probably just a brief intro. Sygnum Bank is the world's first digital asset bank. So we felt probably, well, at the similar time that Anatoly also came up with his business idea, that in 2017-18, I think many of the institutional clients, they were looking into the digital asset space, but I think given the different risks inherent in the digital asset space, they didn't make the step. And we wanted to establish trust in the space by obtaining a banking license from the Swiss regulator FINMA in order to give institutional players the comfort that digital asset banking is actually safe and secure. And myself, I'm heading the clients department of Sygnum Bank, so I'm taking care of all the customer needs within Sygnum Bank. Now, to your question, I think when it comes to digital asset banking, there are huge opportunities. I think the institutional players, they get more and more aware of these opportunities. And what also resonates well with our institutional customer base, but also with the qualified private customers that we serve, is really this inflation fear. I think this is really real, and the monetary supply going up by 28% in 1 year is really a threat to everyone saving money on its bank account. So really forced to diversify, and I think there are different means to diversify. Of course, there are like more traditional inflation hedges. There is real estate, there is gold, but I think more and more people start to realize that also digital assets, with the scarcity, with this 21 million limitation of the Bitcoin, for example, offer very attractive alternatives to more traditional assets. Now, when you make the decision to invest in digital assets, I think what we feel at Sygnum Bank and a lot about digital asset banking is actually educating institutions about what kind of factors you need to consider when you want to make an investment. Because on one hand, you have the investment risk, right? You have the volatility. We now just witnessed over the last 30 days that this volatility can really be significantly higher than probably what we are used to in equity. However, our view is also clear that volatility is not necessarily something bad, but volatility is just something which you need to manage. And we also need to be aware that returns of, like, for example, 300% on Bitcoin in 2020 are only possible when there is an increased volatility. Once the volatility comes down to an equity level, we probably no longer see annual returns of 300%. Now, if you want to make the step, there are certain risks to consider. And I think one of the most prominent risks is exactly what you mentioned, is the safe custody. Because digital assets, they have this specific feature that whoever knows the private key has access to the digital assets, right? So it's like if you lose this wallet, if you lose this private key, anyone who picks up this wallet can actually spend your Bitcoins, your Ethereum. And hence, I think when it comes to digital asset banking, we really wanted to make sure that we build a solution where we can make sure that you cannot lose this key. So this is one risk, that you simply lose it. And if you lose it, you lose access to the Bitcoins in this wallet. So how we tackle that, and I'm staying not on a very technical level, but rather on a high level, is that we're just placing multiple backups. In our case, we were actually engraving this backup of this encrypted private key. Of course, we had to do it encrypted because otherwise it will also be a security risk, but we engraved backups of this private key in metal plates and placed them in different vaults in different jurisdictions. So it means that for tail events, like, for example, let's say a meteorite would hit Zurich, we could still recover these private keys and would not lose access to private keys. And of course, as a digital asset bank, we are not looking at the short term, like, for example, probably some of the exchanges, like, make as much money as we can in the short term, but we are really looking at the long term. So we are here to preserve these digital assets for decades. So this was really important for us, that we can, no matter what tail event happens, we don't lose access to this private key. And I think the other thing that you also don't want is, you also don't want that someone steals this private key. So one thing is you lose it, you lose access to, and the other thing is someone steals it. And for these, we actually used a similar technology, which is also used to store nuclear codes for nuclear bombs across the globe. So we use hardware security modules, and on these ones we store these private keys. And through these, we can actually make, well, I think we all sleep well with the nuclear codes stored across the globe, for example, in the US, and we use the same technology that, for example, Israel or the US are using to store their nuclear codes. And this is also the technology that we use for our institutional customers to store their digital assets. Probably now that we touched upon this custody question, which is a very important one, and I think almost every institutional customer that we onboard, they actually want to run a due diligence on the custody solution that we offer. But probably if we have 1 or 2 minutes left, I also would like to give probably a bit of an outlook of what kind of behavior we saw of institutional customer now throughout the last 30 days.
Sure.
I think quite interesting for us to observe that I would say this volatility is, of course, always 2 ways, right? And we were probably also a bit surprised of how fast the move was on the upside. So I think Ethereum went from like $1,500 to like $4,400 within a matter of days. I mean, that's a huge increase within a very short period of time. And I think many of our institutional customers also took this opportunity to take some profits. They didn't take out all their investments, but they just said, you know, if we make like a gain of 100, 150% over just a few days, it's probably time to reduce the exposure a little bit. And now at the levels of like on the Ethereum of on the 2000 level, on the Bitcoin of the 30,000 level, we also see that they now see that there is a buying opportunity again. And they re-enter the space at these kind of levels, and that's also a bit of the housing. We think that, of course, in the long term, probably the recent pullback offers quite an attractive entry opportunity. Then what we also see, and this is also a bit of the housing, and I think Anatoly talked a bit about the DeFi space and how interesting this is. I think what our hypothesis was at the beginning of the year is that the first wave of crypto adoption or mass adoption of crypto was really Bitcoin. So we saw only buy orders on the Bitcoin over the last year, I would say. Most of the institutions, they entered the Bitcoin position. And with entering the Bitcoin position, people started to realize there is much more in the digital asset space. And our hypothesis was always that the second investment after Bitcoin is Ethereum, because probably you realize that this network value of Ethereum might even be bigger at one point in time than the value of Bitcoin, which is probably more a store of value. And what we see now is probably the institutions they entered now over the last couple of months. That's probably also what led to this significant price increase. And we think that the adoption of DeFi, especially like from larger institutional customers like the family offices, but also then probably the pension funds at the later stage, these probably still take 6 to 12 months. But you know, then, and you mentioned it, Anatoly, like we talk about 50 billion today, but of course, if we look at the financial system as a whole, 50 billion is just peanuts. Like if we look at the institutional space, for example, we talk about 80 trillion of assets under management. So if this money flows into the space, we are quite bullish on this DeFi sector because we see still a lot of upside. And that's in a nutshell how we are positioned at Sygnum Bank and what kind of service we offer to our customer base.
Thanks. There's a question in the chat from Melanie Griffiths from Equin. Melanie, thanks for your question. It's saying, given the challenges to having a unique key, can someone manage cryptocurrencies on behalf of someone else, like trustees managing on behalf of beneficiaries? Is that something that you see, Martin, these keys being held within corporate or trust structures?
Yes, that's something that is possible. So within Sygnum Bank, we offer like escrow, we offer also trust structures, and how we solve it like technically on a high level is just that, of course, there is only one key controlling the assets, but actually we can, of course, through a user interface, we can then grant access to this private key to different individuals. And we can do this like, we can grant access only if 3 out of 10 people perform a certain action, only then we go and effectively use the private key, or 10 out of 10, or a trustee or an escrow agent in combination with a certain third party. So technically we can accommodate basically almost all authorization setups to use this private key. But yes, this private key is only once available in this hardware security module that we are using, but on the front end, we can accommodate almost any authorization setup that our customers need to have.
Okay, thank you. Well, maybe Melanie, one for offline with Martin to work out how you can work together on that kind of basis. Thank you for that, Martin. I'd like to bring in Aaron Payas from Hassans in Gibraltar. Welcome, Aaron.
Yeah, hello. Hi, everyone, and thank you for having me.
So Gibraltar has developed an offering around crypto and generally on DLT technology at breakneck speed that really, brought together a lot of expertise and infrastructure. I mean, perhaps you could just give us a sense of the sort of activity you're involved in from a legal perspective.
Yeah, for sure. Well, I think just a bit of background on Gibraltar. 2016, 2017, primarily, we saw a lot of interest from the crypto space. People wanted to set up companies here in Gibraltar to do ICOs primarily, but among other things. So we were lucky enough that the Gibraltar government, via the Finance Center and the regulator, the Financial Services Commission, they took it upon themselves to develop a regulatory framework for the DLT space, and they put a lot of resources and a lot of work into it, which was kind of awesome for us as industry players, because the lobbying was kept to a minimum. The work was done by the government and by the regulator, and basically we were told, listen, here you have it, go out and get business. So that was an amazing starting point for us. I believe that New York had the BIT license a while back. I think Gibraltar was second to have bespoke DLT regulations that came into force on the 1st of January 2018, so already a while back. And that was something which a lot of clients and a lot of big companies were actually demanding. They were doing really well, the likes of eToro, the likes of Sapo, the likes of LMAX. They were doing incredibly well, but they saw the value in being regulated. They saw it as a seal of approval that would allow them to raise money themselves from investors, but also attract even more clients, and more importantly, institutional clients, which was something which it's always difficult if you're not regulated. So we've been seeing all types of crypto work here in Gibraltar, so from crypto funds to regulated DLT companies with a DLT provider's license, to in the DeFi world, we've seen pre-DeFi we saw the ICOs, but now 2021 the trend has really been DeFi. I agree. I think someone mentioned. I agree that COVID. I think it was Anatoly. I agree that COVID seemed to have been a big factor in for whatever reason, whether it's people having more time on their hands, being at home for longer in front of their computers, but the interest in DeFi was incredible. And so we've been doing setting up foundations, setting up the tech development companies here for the projects, setting up the token issuing companies. So we've seen a bit of everything around DeFi. And we've also seen a big trend in crypto funds, which maybe going back to Melanie's question before, it's kind of a way to delegate that risk of holding your own keys. If you're not tech savvy, then having exposure through a regulated fund, and Anatoly will of course tell you all about this. It's a great way to have not only someone else who knows more than you managing your funds, but the indirect benefit, which is one of the ones which I love most as a funds lawyer and a crypto lawyer, is that they are also acting as your custodian. The arrangements of the fund, it's as if they're providing the custody for you as well. So it's a very neat proposition. And I always give the example of myself, right? I hold my Bitcoin personally. I hold my own private keys. But my exposure to DeFi is through a fund. I'm not. I can't be 24/7 tracking the trading screens, and/or I need to sleep at night as well. I can't be worried about losing my private keys.
Thanks for that.
We'll take care of this.
Absolutely.
Exactly.
Partnership. No, thank you for that. So, Aaron, I mean, you're a funds lawyer, but how do you see the interaction with some of the private wealth and residency side in Gibraltar? Do you're creating some corporate and institutional structures. Is there a private wealth component in some of the clients you're working with?
There's a lot of interest in both the, crypto businesses, so the regulated entities that are already here. There's a big interest in traditional equity investment into these businesses, but there is a big interest for the regulated crypto funds that are in Gibraltar. So they are actually considering the unregulated private funds, but there is a big preference for the regulated funds, and some of the funds which I represent are raising large amounts of money. I think Anatoly alluded to this earlier. They are raising big amounts of money because when the institutional money starts moving, we know that you better brace yourself for what's coming.
And I mean, what kind of cross-border projects might you work on with professionals? Are there certain jurisdictions that you just work with all the time? Give us a sense of what your daily life is like interacting with professionals elsewhere too. Where's the sweet spots? Yeah,
well, it's madness actually. So for the first time, I had a client from Hawaii, and that's the complete other side of the world, the 12-hour difference. So yeah, we deal with clients in Singapore. We have clients, mainly Singapore, some in Hong Kong. We have a lot of Israeli clients, a lot of Swiss clients, and other parts of the EU. But we also have many US clients. And what we are seeing now is, and it's in a way coinciding with the news from El Salvador, we have a lot of Latin American clients. As you may know, or as the viewers may know, Gibraltar has a land border with Spain. So although English is our first language, we are bilingual, and that is very helpful when dealing with Latin America. So there are many opportunities there, which we're trying to. It doesn't come without risks dealing with Latin America. But there's opportunities to do a lot of business as well. So a lot of interest. And I mean, Brexit has obviously thrown up challenges, but also you're seeing some of the opportunities as well coming out of that, where people are focused around the UK. I mean, perhaps explain how the Brexit scenario works in this context, or what's it leading to in a positive way? Yeah. So Gibraltar was part of the EU by virtue of its relationship with the UK. So when the UK decided to leave the EU, then we left with the UK. So right now, as it stands, and it's something which of course is being worked on, is that we lost access to the single market. So our financial services firms lost the passporting rights, but very importantly, we retained the passporting rights to the UK, which was always a big market for our businesses anyway. So kind of the opportunities are, we've actually seen the risk was always having Gibraltar companies move away from Gibraltar and into EU to remain part of the single market. We've actually had EU companies moving to setting up shop in Gibraltar so that they can retain access to the UK market. So it's an incredible dynamic how that has turned out, and with funds as well, if I have time, with the Alternative Investment Fund Managers Directive and regulations, there is a threshold of 100 million euros, where if you're below that, you're considered a small AFIM. You don't need to have the full license. Above that, you need to apply for the full AFIM license. But now that was a big barrier, that was a problem for a lot of our funds. And now that we're outside the EU, we're working on a dual regime, which will be announced hopefully very shortly, which we opt out. Our funds can opt out of the AFIM rules, and that ceiling goes away. So we're hoping to bring back the much bigger funds that were here before AFIM was introduced. So yep. So with all of the negatives from Brexit, we're hoping to capitalize on some of these potential advantages.
Brilliant. Great to hear. Thank you, Aaron. And finally, I'd like to come to Daniel Biesuz from ILFP in Zurich. Welcome, Daniel.
Hello, David. Hello, everybody.
We've worked on some crypto events before in Zurich and elsewhere, which was great to do. So great to be chatting with you today. Perhaps you could give us a sense of the work you do from Switzerland with clients coming to Switzerland wanting to set up. What are you seeing in terms of the trends in activity around this space?
Yes, we at ILFP, we focus on set up legal structures for our clients in Switzerland and in Liechtenstein. So we incorporate companies for them in Zug or in Liechtenstein, set up all the legal structures that they are able to work properly. Most of them are coming from the tech space. A lot of them are in the crypto business. And I can say that I see it kind of goes with the Bitcoin price. In 2017, we had a lot of companies that wanted to do an ICO and set up structures, and then there was crypto winter where there was not a lot of business coming in from the crypto space, and now when the Bitcoin price is up again, everybody wants to do something. Now the narrative is DeFi and NFTs and these things. But I have to say, we from a legal side, we are ready. We have a good legal framework in place, not only in Switzerland, also in Liechtenstein and in other places like Malta, Gibraltar. So I think the law is always behind of business, but it's catching up. And I think we have everything to move forward, to structure things, to work successfully. The biggest issue from my view is still banking, which is very, very hard to set up. And I'm happy to see players like Sygnum, Seba, and others like Merky Baumann or Bank Frick helping the space, because it doesn't help if you have a legal framework that works out for you, but you don't have the players in the market that supports you and gives you custody or helps you with all your business. So I'm very happy to see that. We're moving slowly forward. It's still very hard to onboard clients, but we're getting there, and that's the biggest issue we're dealing with in a day-to-day basis at the moment.
I mean, do you think that the Swiss banking heritage, like you're saying there, that there's not enough real product in the marketplace? Do you think that the heritage helps or hinders? Does it mean it's more traditional and it's less willing to innovate because it doesn't want to compromise the good traditional business that it has? How do you see that?
Yeah, the traditional banks, the retail banks, they are still not open for any crypto business, for any blockchain business. So you cannot work with them at all. UBS, Credit Suisse, and all these, they don't open accounts for such projects. But there are small players, private banks. The thing is, these small players, they are more expensive. That's in the nature of them. So if you have a startup, it's not always the best for them to pay a lot for a bank account, but there's no other way. But what I also saw is a lot of projects, they just try to avoid fiat at all. So far, they can do. It's not always possible, but they like to transact with stable coins, which works pretty well. Borderless, frictionless, transact with stable coins, and then when they need to cash out, they cash out through Kraken or another exchange, and then pay the bills in the environment they need the fiat money. But there's a lot happening, from my view, in the crypto space, in the stablecoin space, outside of fiat.
Okay. I mean, are there any sort of jurisdictions that you see moving ahead, or are countries developing in parallel? I mean, before the call we were discussing about the attitude in, say, the US is very much further ahead than other jurisdictions. What do you see from Switzerland?
The thing is, the smaller the country, the easier it is to change the rules and the law. And that's why Liechtenstein has an advantage over Switzerland. They were faster. They had their blockchain law faster in place. And Switzerland has an advantage towards Germany or the EU and other places. But I think meanwhile you have a lot of jurisdictions with good legal framework. But that's, as I said before, it's not the only thing. You also need to have know-how in the environment. You need to have players that know how things work. You need to have banks that know how things work, auditors, and also the authorities that are able to understand these things. And you know, it's not easy for also, let's say, for a bank when you get a business plan presented from somebody dealing with blockchain and technology, and you need to understand what they are doing, otherwise you cannot onboard them. So I also understand that it's not always easy for them, but it's the future and there's no way around it.
Okay, I mean, Aaron, how do you see the banking side developing there? It seems to be, you know, it's a frustration. It's something I've heard time and again, but how do you see it from Gibraltar?
Yeah, no, it's always a problem. We've been lucky in Gibraltar. Even back in 2017, we have a private bank here called Zurich Private Bank, and they took it upon themselves that they were going to get up to speed with crypto and try to take as much of the market as possible. What ended up happening is that they took the whole of the market because they were the only show in town. So one of our unique selling points for a long time was the fact that we could bank whichever business came our way, and that was incredible for the jurisdiction. They still remain very active, although as you've mentioned, we see clients working with Signature Bank, with MCB, with Silvergate, even Clear Junction. There's a few other options now out there, but I agree with Daniel absolutely that it remains a big sticking point. But my view has always been that the big banks have always tried to slow everything down until they are ready to step in. So let's see how that plays out.
Anatoly, what's your perspective on that? And what point are we going to get to where the retail banks, or there's a broader support for the ecosystem?
Well, it's either until they are ready to step in, or they are forced by their clients to participate in this evolution. And exactly that's what we're seeing from many investment banks. Look at Morgan Stanley, Goldman. At the best, they were neutral towards crypto. I would say even there was a negative perception of this space up until last year. And then once you have your wealth management clients pushing for that, well, you have to take a view. You either lose them to other institutions or you provide access to the market. As I had a conversation with Credit Suisse, and one of the senior managers told me, listen, we don't see any demand from our clients. I was like, are you sure? Because I just had 20 million in flow from Credit Suisse. I'm not sure they consulted with you, but the fact, of course, they are looking for this exposure. And if you as an institution are providing this, they will find other way to get to build this. So I think what we're going to see is over time, it will become part of the pretty much normal banking. Not today, I agree. For us as a player in this space on the professional level, we have access to a very specific banks, which are not only crypto friendly, they're designed around crypto ecosystem. There are two major banks in the US in that respect, Signature and Silvergate. Essentially, you have all major exchanges banking with them, and all major investment managers also banking with them, which is great because you can transfer fiat from, say, my account to Coinbase in a matter of seconds because it's kind of intra-bank transfer. But this is still kind of a unique value proposition because these two banks were designed around crypto. Those who are deeply embedded in a traditional banking, they may see this as unnecessary and unwanted hassle, right? Because you have to face regulatory scrutiny, what procedures you have in place, what your AML KYC, which honestly is not that different to the normal world. But look at HSBC. HSBC consciously decided not to be in crypto, prohibit any transfer to the exchanges, which is ridiculous if you think, right? How is it different? If I am a cleared client on the KYC front and I have made deposit with HSBC in sterling, if I were to bring dollars, would that freak them out? Of course not. Kind of, it's fine to have another currency. Why Bitcoin immediately makes you enemy of state? Same person. I have different exposures. So I think this is still a legacy of the thinking, but it's only a matter of time. What would help here is regulatory clarity. because we are missing this still, right? You have these various viewpoints, very often kind of left in limbo, how commercial banks should be treating this exposure and so on. And for many of them, it's easier to stay outside rather than embrace. But again, it's only a matter of time. I think we're going to arrive when it's going to be pretty much universal.
Thank you. And just as we bring this conversation to a close, I'm just going to come to each of the panel for a closing comment, a thought, something to leave the audience with, something you might want them to follow up with you on or think about. Perhaps Sid, come to you first from a legal side. What's the one thing or couple of things that you think this audience should be cognizant of?
Right, well, I'm hoping you can hear me. I know I had issues earlier. To be honest, in terms of closing remarks, I fully agree with what Anatoly just mentioned, because what you can see is from a regulatory perspective, in particular with the UK, we're just too far behind. We've seen commentary from, for example, the UK regulator, the Financial Conduct Authority, and we've not really, all we've heard is comment, no sort of real action. But when you compare that to, for example, the US, we've seen action being taken by the Department of Justice or the DOJ, for example. So I think regulation is something that needs to happen in order for this space to grow.
Thank you for that, Sid. Martin, do you have a closing comment from Sygnum? Oh, you're on mute there, sir. You're just on mute.
Yes, hold on. Yes, my comment is I think people are very much aware of the risks of investing in the digital asset space, but they are a bit less aware of the risk of not being invested in the digital asset space. And today, as a responsible CIO of a family office or a responsible CIO of a pension fund, not to have an allocation is a strategic mistake. You underestimate the potential of a new emerging asset class, which is here to stay. And I think my last word is really about be aware of this risk and start acting responsible towards your customers.
Okay, thank you. Aaron, a closing comment from you from Gibraltar.
Yeah, I think touching on legal and regulatory certainty, I think that is what Gibraltar has most. I think that's important to say. So my only comment would be, it's very important to do jurisdiction shopping and look at all of the options. But as I always say, I don't think that exercise is complete if you haven't considered Gibraltar. So final remark.
Thank you. And Daniel, from Switzerland, what's your closing comment thought?
Yeah, I still think we're seeing a big opportunity here. Things are changing, and that's a big opportunity to take advantage of. And I think we should get it on. And everybody here is, I think, on the same page. We have to build something in the space and work on it because it will be part of the future.
Great. Anatoly, a closing word from you as we wrap up this panel discussion.
Yes, so whilst investors should look at this space in various fashions, market neutral, kind of delta neutral exposures, looking at DeFi, I will come back to this point. I'm going to show this one slide, which to me
is sure, go for it.
Very impactful. If you look on BTC, it's roughly 1 trillion market cap. If you buy into the concept that Bitcoin is a digital gold, your traditional gold is roughly 10 trillion. So the factor of growth is 10x. But then if you look on DeFi and look on the traditional space, global bonds, bank lending, mortgage market is $140 trillion. And then you look on DeFi lending protocols, which is roughly stands at 20 billion. And then think, wow, this is kind of interesting comparison because more efficient algorithmic services will eat into the traditional banking system. Now the question, how much they can take? Can they displace banking system? Perhaps no, it's going to be a stretch. Can they take 10% of this addressable market? The answer is, of course they can. Over the next, say, 10 years to be on the safe side. Well, the growth factor is 700x for where DeFi is today, just to go for 10% of the addressable market. And I think that's a very important opportunity for many investors to have a closer look. It requires significant time commitment because you have to navigate through these massive idiosyncratic structures of DeFi, but it's worth the effort. That's the opportunity.
Fascinating. We're going to cut the live stream now.